invited Bill Harrell and agreed to come here because very unique experiences in running a money management firm that we wouldn't really see very often, and also knows a very unique perspective on markets. However, he, in the 8 years we've been doing this, is the least qualified person that we've ever had to give you advice about how to interview for a job or how to polish a resume, because you never successfully have interviewed for a job in finance.
That's not totally true.
Okay.
I worked for 1 month over one of the summers that I was here in Dallas.
1 month in the summer. So grew up in Tampa, went to Duke University and Duke University Law School, and practiced law for a while. Came here and got his MBA, and with his brother started Capco, which we'll talk about today. Very exciting story. And somewhere in there, he did interview for a job. And did you interview with your brother when you started the company? Did he hire you? Or?
I put him through a rigorous 30-year interview.
Very good.
Yes.
Thank you. And he'll take questions. We'll take questions at any time. And it's going to be no PowerPoint, informal. Thank you.
Thank you, guys. Thanks for having me. Before I go into more substantive things, Dave is the teacher that I always cite for a principle that I really believe in, and that is that it is way more important to pick the teacher than the class. When I arrived at UF for the MBA program, you would have been hard-pressed to find anybody that had less interest in studying fixed income than me. But you had to take the first class. It was part of whatever curriculum track that I was on, and once I took it, I was hooked, more by the teacher than by the subject. So I don't know how many of you would be first year still or still have a chance to come back to them, but I highly recommend it. I got a ton out of it, even though I'm not today a fixed income practitioner. Okay, so Dave gave you a little bit of my background. I was a lawyer for 10 years. I practiced in commercial litigation. I was with one firm in Tampa. I was a partner there. Along the way, I developed a more than casual interest in Warren Buffett and value investing, some of the other practitioners of that. I was fortunate in some ways that my learning curve took place as the tech bubble was roaring, and I was perhaps suitably skeptical of it. And when it crashed, I decided that I was the greatest thing since sliced bread, and by God, I needed to go into this business. And so I started making plans to do so. And in 2002, I quit. I quit my job. I entered the MBA program here, and I started my fund, and I ran the fund while I was here. After I graduated, my brother, who was already in the business, joined me. So that's kind of, and we're now in year 7, actually, a couple months into year 7. So that's kind of my background. I was going to leave this part out, and then I was going to say, people often ask me if the practice of law was a helpful foundation for finance. I decided that was boring. I'd leave that out. And then at lunch, somebody asked me that very question, so maybe I'll go ahead and answer it. Anything you do in life is obviously going to have applicability to whatever you do later. So any experience that you apply yourself to, I think, is valuable. Specifically, one of the great things that I think comes out of the law is what I think of as the habit of proof. The law, over hundreds of years, has built up all kinds of rules around the basic idea that we only want to consider in the decision-making process high-quality evidence. And most of what that means is primary sources. There's a forest of rules around keeping out stuff that I heard somebody say, or things that are opinions as opposed to facts. And the habit of probing through those, of figuring out how you're going to present your case and prove your argument with primary source information is very valuable. And I think another thing the profession gives you is a healthy skepticism about facts that people are relating to you. Not only do you have to question what the other side is telling you, from the very first meeting with your client, you have to be skeptical of what they're saying to you. I'm not saying clients are all dishonest people, but they come in with biases. They often come in feeling like they need to give you the information you need to win, and maybe you don't need to know about this bad stuff. And it is the lawyer's job to probe, to find that stuff out before he commits himself to something that a bad fact might make a problem. That habit of skepticism, that habit of proof is very valuable, and it's something that can come out of almost anything you do in your life, any business. One of the first things people ask is often, have you done relative to the market? And fortunately for me, I can say that the answer is, after fees, we have outperformed the market by a small margin. And so in that sense, I suppose we've justified our existence. I think that is absolutely the wrong question for anybody to ask a manager. And so, I mean, one of the things that perhaps may come out of this to be of value to you in your life is that's not the way to go invest your own money. Do not go pick somebody solely on the basis of performance. If that was the only reason that a client was hiring me, I would not want that client. So, what do we do? How do we go about it? How are we different from the majority of the industry? And if you're in the money management business, there's going to be a lot of similarities to the industry. There's some things you can't get away from. But I flatter myself that we are different in quite a few ways. Give you a brief summary of them, and then I'm going to go through them in a little more detail. First of all, sort of an overarching theme, we are big believers that successful investment management requires a consistency of your philosophy, your process, and your personality. I think that is probably an underemphasized principle in the selection of investment managers. I highly recommend it. It gives you all kinds of questions to ask and ways to think about an investment idea. And you can judge for yourself as I go through our criteria how well that is true of us. First, we're a concentrated investment fund. We would not call ourselves diversified, which is the far more common format. We are value investors. That means we focus first and foremost on business, people, and price. Excuse me. When we invest in a company, we invest in it on the basis that it is a business. We are owners of it as if we owned the entire thing. It's not a piece of paper that we're hoping we'll be able to sell to somebody else 6 months or a year down the road. We're very focused on preservation of capital, being disciplined about price, and looking for margins of safety. Risk. This is probably the only area where I will perhaps diverge a little bit from the traditional MBA curriculum. We view risk as qualitative, not quantitative. I'll talk about that some more too. We avoid arbitrary rules about what we can buy. The industry is, many managers are straitjacketed by arbitrary rules that they're going to be small cap value or large cap growth or what have you. We think that's a bad idea. That's not the way we do it. We are agnostic about the industries that we invest in, and we do not have what's called a full investment mandate. It is by far the most common characteristic of most investment funds that they try to be fully invested at all times, that they are almost fully invested at all times. Over the life of our fund, we have held very large percentages of cash virtually the entire time, and we think that's the right way to go about it. We have low turnover and long holding periods. That's sort of the same thing. We are research focused, and we have pretty specific ideas about what we want in the way of clients in terms of the mutual fit that we are looking for. So what do each of those things mean? This is maybe one of the most important concepts in investment, concentration versus diversification. If you take the vast majority of the investment universe is diversified active management. To our way of thinking, that's an oxymoron. If you are diversified, you are more or less assuring yourself of an average result. There's nothing wrong with an average result. If you have also hired active money managers to achieve that, then you have assured yourself of underperformance. I think everybody here would have had your first statistics class, and So you get sort of, if that's the bell curve distribution of individual stock returns, and you think of every mutual fund as a sample of that, then the mutual fund returns are going to cluster even more tightly. And then you, as an investor in a mutual fund, paying, let's say, 2% or something in costs, are going to cluster over here because the fees move you from here to here. That's an absolutely terrible chart that doesn't look nearly as informative as when I imagined it, but I think you get the point. There's another one that I got this from Jack Bogle, who's the founder of the Vanguard funds for index investing. And he derives it from something called the Dalbar study. If you Google it, you can find it. There's a bunch of, depending on which time period they're measuring, the numbers come out somewhat differently. But it's one of the most compelling anecdotes in finance. And that is, this first bar chart is, say, a 20-year average market return. And depending on which 20-year slice you take, the number can be different things. But let's say it's 9%. The second bar is for the average mutual fund. And the average, when you take mutual funds in the aggregate, they are the market. Their gross performance is going to be the same 9%. Their average performance is something more like 7% because they've got to pay fees and a lot of expenses and that kind of thing. And this is what I think Bogle calls this the cost penalty that the investor incurs. This is the selection penalty, which we'll talk about more. And I've seen different numbers for this. Some of them are truly horrible, as low as 2%. I find that a little bit hard to believe, so I'm going to use something a little more cautious and say it's 5%. This 2%, this is the market index. This is the average mutual fund, not weighted by the size of the mutual fund. Every mutual fund gets the same treatment here, or the same weight. This is the mutual fund weighted by dollars of investment. And so you look at this and you say, this is the return that fund investors actually received. All of the investors who were invested in these funds ended up with this. You look at that and you say, well, that's ridiculous. How can you go slower than the boat that you're rowing in? The reason is that people systematically buy things that are expensive, sell things when they're cheap, chase performance, get into what's hot. They're in the wrong places at the wrong times. I think indexing makes a lot of sense. I think it ought to be everybody's default equity investment, unless and until you come up with something better. I'm not an indexer. It doesn't do me any good to say that. I just think that's the starting point for the decision. I will say that one interesting thing, a chart that, or a bar that Jack Bogle does not put in his table, is this for the index fund investor. Because the average index fund investor has a very small cost penalty, maybe 25 basis points, but the average index fund investor does the exact same thing that this guy does. He jumps in when the index is going hot and has had great performance for the last 5 years, and when it crashes, he jumps out. He's buying it high, he's selling it low. So this piece of it diverges from the concentration point that I wanted to make, but if there was, I've given speeches where I hand that out, and I say basically, that is the single most important slide in investing. If you understand that, you know most of what you need to know to go make fairly reasonable, fairly intelligent decisions about investing. It won't turn you into Warren Buffett, but it will keep you out of a lot of trouble. So, if there was one takeaway, it would be that diversified, active money management is almost never going to make sense. I'm not going to say never. There's always some exception that turns out to be reasonable, but you ought to require a very high burden of proof before you believe that a diversified, active strategy is likely to outperform an index fund. in our business, we talk about competitive advantages a lot, and I'm going to talk about them some more. Index funds have a fundamental competitive advantage that is structural and permanent over that strategy. And so if you're going with the inferior strategy, you should have very good reasons. So that's that piece. Now, diversification, I've said that's the default choice, the diversified index low-cost approach. Diversification assures you an average result. It does not assure you a good result. That is more obvious now than when I would say that in the past. Index funds had a tremendous record for a very long time, and there's a tendency to say, well, the average result is great. I want the average result. Well, sometimes the average result is not so great, and it's therefore less desirable. If you want something different than the average result, you must concentrate. Period. End of story. You can be diversified, and maybe you'll be one of the lucky people that ends up in one tail or the other, but your expected result is going to be the average diversified result. If you are going to concentrate, you are taking on more risk in the traditional academic sense of deviation from the mean. You should have a good reason to think that your deviation is going to be favorable and not unfavorable, and that's a lot of what I'm going to talk about from here. As a point of reference, how concentrated are we? The average mutual fund, the last time I saw a number, which has been a year or so, so it's a little out of date, the average mutual fund owns 147 stocks. That's, you know, as an average position size, that's about 2/3 of 1%, which is, in my opinion, a little bit poor as a measure of somebody's commitment to an idea. But leave my editorial aside. The average is 147. We own 18. That's the most that we've ever owned. Is that concentrated enough? Is it too concentrated? I don't know. It's hard to say. We like it. It feels like maybe a little bit too many, perhaps. Phil Fisher, who is now passed away, but he was an unbelievably successful investor for decades, doing the kind of work that we aspire to do. He thought the right number was 6 to 9 companies. Charlie Munger, who's Warren Buffett's partner, has said that the right number, if they're the right company, is 3. Now I say all that, and before Dave jumps up and says, "My God, what are you telling these people?" You know, what I'm telling you is how much concentration makes sense to move away from diversification. I am not saying, by any stretch of the imagination, that you guys should go put all your net worth into 3 companies. I think there are huge hurdles that anyone should get over before they decide on that much concentration. If you're going to concentrate, you must be right. Please.
How concentrated is your 18? Are they all in one?
Very, very. I mean, yes. He asked me, how concentrated are the 18? It is, I'm going to pull a number out of a hat. I'm going to say 75% of it is in the top 8 or 10. It's probably about right.
For your average customer, what percentage of their net worth are you managing?
So Dave's question is, for the average customer, what percentage of their net worth are we managing? Which is a good question. I think what you're asking is, you know, do they view us as a risk that they are in turn diversifying away from? And the answer is, it varies. We don't have any kind of financial planning aspect to what we do. I mean, anybody that wants to talk about anything, we'll talk about anything, but we don't try to plan anybody's whole picture. We don't try to say, here's how much of your money should be with us. That's for them to decide. There are some people for whom we are a very substantial portion of their investment. There are some people who have allocated to a variety of different things they like, and we're one piece of the puzzle. Go ahead.
Do you at least try to diversify across different sectors within those 18 stocks, or is that completely?
There is some I'm going to come back to that in a later part, but there is some diversification among industries. We're conscious of it. I wouldn't necessarily want to own 18 insurance companies. I probably wouldn't own 18 insurance companies. There's probably 2 that I'd be willing to own. And I probably would not put 100% of my net worth into 2 of them. excuse me, I think that's kind of the question. When I cite the Phil Fisher says 6 to 9 companies, Charlie Munger says 3 companies. I mean, some of that is a measure of, okay, you're confident. How confident are you? Are you willing to put it all in one company? You know, if you were confident enough to put it all into Berkshire Hathaway or all into Microsoft, great, you're a winner. If you were confident in Enron, you weren't. And so, I mean, it's an individual thing. It comes down to that. And I think putting it all into one industry is not far removed from putting it all into one company. Okay. Okay. So, so anyway, I would not willy-nilly run out and concentrate all my investments until I was very confident. I mean, another of the great concepts that comes from the law is the idea of burdens of proof. And you know, if you're in a car accident, you and the other person are going to go in there, and the winner is going to be whoever slightly tips the scales. All you got to do is tip the scales a little bit. If, however, you're charged with a crime, our rules are different. And we say the evidence has to be beyond a reasonable doubt. That's simplistic. Everybody knows this, but it is incredibly important in the outcome of decisions. If you set the standard of proof like this, it's very, very hard to get a false positive. To convict not impossible, but to convict somebody who is innocent. The rule of decision that I would use for deciding to concentrate, I'd want to be confident beyond a reasonable doubt. Not confident beyond a doubt, but confident beyond a reasonable doubt that I had a good basis to do it. So the way that we think about risk, we think risks are qualitative, not quantitative. I was here for 2 years too, and I worked through all the same problems of beta and volatility, and heard all the same lectures and read all the same readings on beta and volatility as measures of risk. In my professional life outside of school, I've never calculated a beta. I've never used a beta. I don't consider it helpful. We look at risks as fundamental things. There are risks from competitors. There's risk that your demand dries up. There's risk that you borrowed too much money. There's risk that your product gets replaced by technology. There's risk that you depend on access to the markets for short-term capital, and that could dry up. And when we invest in a company, we try to think about every imaginable, some very wild blue sky yonder kinds of risks. And we think about what could those mean for this company? How likely is it to happen? If it does happen, then what? You know, one example is Anheuser-Busch, which used to be a very large investment for us. And at the time that we invested in Anheuser-Busch, there was beer had done very well against other kinds of drinks for a long period of time. There was a decided trend towards high-end spirits, craft beers, import beers, and there was somewhat of a glut of supply of good wine at low prices. And so all of these different products were gaining share against beer. We didn't look at Anheuser-Busch's beta. We looked at that and we thought, how likely is it? How deep could the inroads be of these other kinds of alcohol on beer? The same thing is true of Costco. I mean, we think Costco is currently one of our biggest positions and has been for a really long time. I mean, when we think about Costco, we think, what could go wrong with that model? And their model is primarily they're a low-cost operator, a low-cost distributor of consumer products. I take it almost as an article of faith that a low-cost operator has a decided advantage over others. How can that go away? Somebody else could copy it or improve on it, have a better low-cost model. That's something that we are vigilant for. Or Costco could weaken in its own commitment to the model and could slacken. And that's something we're vigilant for. Those are the risks. When it comes to beta, we think there's lots of reasons for volatility besides risk. Beta hasn't been very predictive. There's a great book many years ago about the ills of Wall Street that asked where are the customers' yachts. It's a great title. And the question I always ask of beta, the idea being that high risk correlates with higher return. I have always been curious to hear, where are the yachts of the high beta investors who systematically captured great returns with that? There's probably something wrong with my question. Dave could probably tell me what it is. But until then, we'll keep thinking about risks as real-world qualitative things. Arbitrary rules about positions. There's a number of these. When we set ourselves up, we got to write on a blank slate, and we got to do whatever we thought was reasonable. One of the things we thought was unreasonable is the industry has developed a very strong focus on style boxes. Many managers manage money based on a particular style box classification. They are a small cap value manager, they are a large cap growth manager, they are a high yield junk debt manager. That's what they do. They stay in their box. People hire them because they're in that box. They hire them to do the high yield thing, and they are not supposed to stray from that box. That has never made much sense to us. I'm going to talk about our criteria in a little bit. Basically, we like to own high quality things and we like to buy them cheap. There's not a whole lot of room in there to say, but we only want to buy it if it's small, or we only want to buy it if it's big, or we only want to buy it if its price to book ratio is less than the median. We don't segment the world that way, and I'll give you a couple quick examples. A couple years ago, we looked at Dell and CDW, which is a smaller competitor. Dell's huge, it's a big cap. CDW is, I don't know, smaller, mid cap, certainly much smaller. We liked CDW by a lot. We didn't like Dell really very much at all. In that case, we preferred the small company. When we invested in Anheuser-Busch, there's plenty of craft brewers out there that you can go invest in as well. We liked Anheuser-Busch. We liked the big company in that case. The fact that, now in their case, size meant scale, and scale matters in that industry, and that's a lot of why we liked it. But there was nothing intrinsic about the fact that it had a large market value that made it more or less desirable. Another arbitrary rule that I think plagues the industry is what is referred to as the full investment mandate. So the manager is in his style box. He's supposed to stay in his style box, and whatever cash he is given, it all needs to be put to work in that style. And so if I am, say, a junk bond manager, and client sends me money, I am expected to put 100% of that money to work in junk bonds more or less immediately. There may not be any junk bonds that I want to buy. I may think junk bonds are entirely too expensive, but it is my job to invest in junk bonds. We were talking about this before, and as Dave said, if I don't, the client pulls the money back. I think that's silly. I mean, you've allocated money to the person who is presumably a greater expert in this subject matter than you are, and you are pulling away from him the flexibility to make what is probably one of the most important decisions in the whole investment process, and that is valuation. Another thing that you asked about our concentration across industries. We do not have any particular industry weightings. There's obviously there's a lot of managers who don't want to stray too far from the index. The phenomenon of closet indexing, which probably everybody knows what that means. If not, in general, it means you stay pretty close to the index, and at the margins you try to make decisions that give you a little bit of an advantage. We don't do anything like that. That doesn't make any sense to us. We try to diversify somewhat across industries, but we don't have any strict sense that, financials are 20% of the S&P, so we want to have at least 15% financials because we don't want to get too far out of whack. I mean, the fact is we've never owned a bank. I don't see it likely that we're going to own a bank anytime in the near future. I guess never say never. We don't mind straying from whatever those normal weightings are. I said we were low turnover, long holding periods. Those are really the same things. I'll give you a number on that. And again, this is a dated number, but the last time I saw a number, the average mutual fund's turnover rate was 112%, which means they're turning over their portfolio a little more than once a year. Our average over the last 6 years has been 12%, which implies 8 years. Well, we're only in year 7, so it's too soon to say that our average holding period is 8 years. But we certainly expect our average holding period to be long. There's obvious advantages to having a long holding period. One is that you avoid the frictional costs of trading in and out. They're not as much as they used to be, but they aren't zero. You get a lower tax rate when you make it to long-term status for both your gains and your dividends, and you defer taxes, all of which are advantages. It isn't, I don't think you can just say those are advantages and therefore I'm going to buy and hold regardless. Being able to buy and hold is, I think, a byproduct of all the other decisions that go into what you own. Just as I said, you don't want to concentrate heedlessly. You don't want to buy and hold heedlessly. You want to buy and hold because there's a reason. If you buy something cheap and you own it for a short period of time, you can make a very good return based solely on the fact that you bought it cheap. If you bought it at a discount of 25% or something to what it's really worth, if you sell it in the first year, 18 months, 2 years, that's going to be a reasonable return. If you're going to hold it for 10 years and the only virtue of what you bought was that it was cheap, then all you're going to do, you're going to capture that same 25 or 33% discount or whatever it is, but you're going to spread it over 10 years of holding period. And in that case, the fact that you bought it cheap, the fact that you bought it well, is not going to be enough to have turned it into a good investment for you. In order to hold it for a long period of time, you've got to own something that is producing value internally, growing in value in some way. So all of those different things, as I go through them and I say the caution, it doesn't just mean you can do it willy-nilly. You've got to have good reasons to do it. Well, this part of the talk is sort of the reasons. This is what we think of as value investing proper. The basic criteria are business, people, and price. And we want a high-quality business run by really outstanding people, and we want to buy it at a very disciplined price. One of the managers we've followed for a long time likes to say, and we want to steal it. You don't often get to steal it. I want to steal it too. Those opportunities don't come along all the time. But we can be disciplined enough about price that the internal qualities will carry us through. Yes?
You said that your large position you have is in Costco, and in the recent environment, you said that I'm not sure the holding period that you've had. Would you be adding to a position because you have cash reserves on hand in this situation, or would you just allow the market to go about its way and see where it is in 10 years?
Right. The question is, for a large position like Costco, with the market cratering in essentially everything, would we add to it or would we just hold it? And the answer to that question, as to so many questions, is it depends. We have, I said for most of our life, we have held substantial amounts of cash. I'm not sure what the average would be now. When I calculated a year ago, on average, we'd had something like 50% in cash. It'd be less now because we've steadily gotten more invested and you'd have more years in the denominator. We got fully invested at the end of last year. We did that by a combination of buying things that we already owned that were down and buying things that were new. We'd never held anything remotely close to 18 companies before. As we had a lot of companies that we were following that we wanted to own, and in our general plan, we've been pessimistic for a while, and so I wouldn't say we were quite as pessimistic as things have turned out. But we'd been pessimistic for a while, and our plan was to, in a disciplined way, step into things, right, opportunistically, depending on which of the companies that we like come down. If we already own it, and we're comfortable adding to it, and then it could be that company. If it's a new company that we've wanted to own for a long time, then it can be that company. And so what happened was a mix of things. We added to some stuff, and we bought new positions. Now we're fully invested, and so if the next move of our businesses is down, pending new client money coming in, we're, now we're sitting. There's, at the margin, one of the things we talk about is, okay, we own 18 businesses. Should we own 17, sell one of them, and put some of the money to work in something else? At the moment, we kind of like being a little bit spread out, but it's something we talk about a lot. So the framework for our thinking is all stuff that's very accessible to anybody, whether you're in business school or not. The basic framework is all straight out of Ben Graham, Warren Buffett, Phil Fisher. There's others that write about it, but if you went out and you read their works, you'd know 90% of the basic framework that I could tell you to go read. Then, to apply the framework, and none of it is technical. I mean, it's not Greek letters. It's not mysterious things you have to know. You don't have to be a finance genius. It's, it's basic things about what makes quality business. Then you need a toolbox to go apply that. The good news for you guys is basically everything in the toolbox is taught in the MBA program if you take those classes and choose to learn it. The accounting, the financial analysis, the strategy, on and on. Luckily, we don't need to use statistics very often, or I'd be in trouble.
Back up while you're there.
Yeah.
So when you passed on, told people how to find a quality business by referring to these people who know how to do this. But it's
Coming to that.
Yeah. Maybe to jump ahead, it is it's very labor intensive because this is a matter of you alluded to some things like Hough and Costco that you think require understanding that the product and operating environment for that business is essentially bulletproof. Something like that.
Yes.
Right? So, that's not something that you're going to find by, having a Bloomberg terminal in front of you. This is
I agree.
This is a deep analysis of the operating business. How do two guys, find investments in a labor-intensive way? Do you use screens to at least pare it down?
That's a good question. And his question is, I'm going to truncate it a little bit, but your question was, this is very labor-intensive to identify all the qualities that I'm talking about in the business. How do two guys in Tampa do that? And, I started my business when I was here in Gainesville in a little room off the kitchen of my house. And then when I moved down to Tampa and joined my brother, we set up shop in the apartment above his garage. And about a year ago, we moved downtown. So until we moved downtown, I kind of got a kick out of saying, that it is a little bit ridiculous to think that a couple of guys sitting over a garage behind one of their houses are going to go compete with, the incredible array of talent and knowledge and computers and everything that you can possibly imagine that's out there. The good news, though, is that a lot of that stuff is not very helpful for making the decisions that you need. We all have a limited amount of time that we can spend, and you can spend it on things that are really important, or you can spend it on things that are less important. And I certainly don't want it to sound boastful or bragging or anything like that, but I think that we are spending it on the things that are important. And I don't think that we are rocket scientists to have figured these things out. It is time intensive to go do it, but you've got guys like Warren Buffett was just a guy in Omaha who started off with his desk was a closet, his office was a closet that he converted to put a desk into it, and that's where he worked. And there's a famous story about one of his neighbors who turned out to be the president of the Coca-Cola Company one day, saying, he lived across the street from Warren Buffett, he knew about him, and here's this crazy guy who sat home all day in his pajamas picking stocks, and there's no way I'm giving him my kids' college money to manage. I mean, it's crazy on its face. I think the advantage that we have is we're focused on specific things. We are, I don't care what the stock does today or tomorrow. There's an incredible amount of information out there that is noise in terms of, it gets processed by the financial services system. It gets processed and repeated and amplified and talked about, and people go trade on it and all this stuff. But if the question is, does this new piece of information mean anything to where this company is going to be 20 years from now, then you're better off having screened that off. I mean, that's 2 minutes of your life that you're never going to get back if you sat there and read about it. So our office is like a tomb. It's so quiet. I mean, if you sat in our office all day, occasionally you'd hear us fighting it out over some investment idea, talking for a couple of hours about something. But a lot of days, you'd sit there for 2 hours and you wouldn't hear anything. And then somebody'd say, did you see the article on such and such? And the other one would say, yeah. And then we'd be quiet again for an hour. And then we'd go to lunch. Generally speaking, when I sit down to work on an investment idea, I work on it for hours. I don't look at anything else. I have no distractions. We shear off, and there's 10,000 public companies to look at. I can't tell you how many we shear off that we wouldn't even look at because we think there's no chance we're going to prove out competitive advantages in them. We concentrate, just as we concentrate our investments, we concentrate our time on a small number of ideas. And I think that's the difference. Now, it will come down to how well we execute on that and how good we are at it. But I think we're emphasizing the right things. Please.
You mentioned that you outperformed the market in the last couple of years. Do you think
Go ahead.
At least last year, I think. Do you think that's really because of your high cash position in the market that's falling, or do you think it's more because of your ability to concentrate in the right sectors and the right stocks?
That's a great question. Very fair question. The question is, in mentioning that we had outperformed the market, is that really because we picked great companies, or is it because we just sat on a lot of cash? Excellent question. And if what I had said was we outperformed the market last year, and we did, and yes, cash position had something to do with that. It wasn't the whole explanation, but it had something to do with that. We've outperformed the market over the entire life of the fund, including having the cash. So I think definitely, I think the record would say that we've found quality businesses. We've owned very few companies over that time period, and we've made a couple of mistakes along the way, but most of the decisions have been good ones. So, yeah.
Another follow-up to that. You only have 50% invested, and you were trying to, until you had $1 million, and you were trying to match the same amount of returns as $1 million invested in the market. And the market's going up. You got a typical 10% return from the market. You'd have to double those returns to get the 10%.
Okay. What he's asking is, let's say you had $1 million under management, half of it was in cash and half of it was invested. And if you're trying to keep up with the market, then the amount you had invested would have to do twice as well as the market to stay even, right? Okay. Absolutely, 100% mathematically correct. Absolutely agree with that. Excuse me. We are not trying to keep up with the market. When I said we're trying to do something different, I meant it. It is not my goal to beat the market every year. I certainly hope that a byproduct of our work will be that we beat the market over the long term, and so far so good. But if you want to have a different result than the market, if you want the market result, you should go index. No doubt whatsoever. That is the right answer for most people and for the vast majority of dollars. If you want something different than the market, you must go do something different than the market, and you must expect a different result to flow from that. And we do. We expect sometimes we'll be ahead, sometimes we'll be behind, and that's pretty much the way it is. It is. We are proud of the fact that we are ahead of the market with all the cash that we had on hand. If we were behind the market, I wouldn't be apologizing for it. We made the decisions that we made with an eye to risks and only putting our money into situations where we were optimistic. And if those results come out to be less than the market, so be it.
Go off a little tangent from Dr. Brown's question. Your response, you talked a lot about the fundamental things, and then earlier you were just talking about the style boxes, and whereas Bulge Bracket would hire a lot of analysts to be specifically narrowly an expert in the sector, you think you have an advantage not doing that. But so essentially, what's going on is you kind of cover every sector, from the sectors, from the from the style boxes to the large companies and the small cap companies.
How is that possible?
How are you successful doing that? Do you have to be a master of all jack of all trades, or do you just focus on those qualities, and if you can identify those qualities, it happens to work for everything?
The question is right. That's a great question. The question is, if you're going to be a generalist, and we are, and there's only going to be 2 of you, and there are, how on earth do you, and you're going to be so detail intensive about all these businesses and industries, how is it credible that that you do that equation balances, and that you're actually able to do detailed work on that many different things? And that's a great question. And the answer is, we are not an expert in every industry. At lunch, someone asked me about, and before I forget, somebody made a reference that a couple people in here are interested in going to law school, and I just wanted to say, if you want to talk after, make sure you track me down. I lost my thread. How do we cover the ground? Somebody asked me at lunch about sell-side analysts. We don't use any outside research. And I said there's good and there's bad to that. We thin out a lot of noise. We thin out opinions other than our own. We lose access to some very smart guys whose whole life, you take somebody who's been covering, say, trucking for 10 years, that guy knows the trucking industry. He knows all of its issues. He knows its trends. He knows who the players are. He knows a lot about management. He knows when somebody says something, whether he can count on it. He has a huge amount of domain expertise in that area that we don't have and that we've closed ourselves off to. We're not trying to master every industry. How much we need to know about the industry depends on what is the competitive position of the company that we're looking at. What we are trying to have is a mental inventory of a small number of companies that have exceptional competitive characteristics, and we know enough about the company and the industry and the competitive characteristics that we can be confident in its persistence. And I had some examples of specific companies, and I'll speak to them in a little bit. But and if you use Anheuser-Busch as an example, this is one of the things that happens to us is we tend to invest in companies that are pure plays. They have one thing going on, because Lord knows it is hard enough to figure out everything you need to know about one business, let alone something that's in 6 different things, and then the economics of the different businesses get meshed together in the accounting. You can't tell what's going on, even if you could understand the qualitative stuff. Anheuser-Busch is a pretty simple business to understand. When you boil the beer industry down, a barrel of beer sells for about $100, $120, something like that. Let's call it $100. What it costs to nationally advertise your brands is about the same whether you're Anheuser-Busch or Miller or Coors Light. They all seem to spend something on the order of $600 or $800 million a year. Anheuser-Busch is spreading that across 100 million barrels. So when it sells a barrel for $100 or so, it has an $8 per barrel cost of advertising. Coors Light is spreading it across 1/5 of that volume. They're still selling the barrel for $100, but they got to spread almost the same advertising budget across it, and so they're spending not $8, but $25 or $30 a barrel on advertising. There's nothing that's going to close that advantage. There's no technological innovation that's going to change that. If you had a pronounced trend where people just stopped drinking beer, then that's a problem. But we can think about that. We did think about it. We looked at everything that was going on with spirits and crafts and imports and the history of their progression and so on, and we got comfortable with that risk. If something is beyond our ability to be confident that we understand it, then we just don't do it. Not every business is quite as simple as some of the examples that I'm using here, but once we understand it, it tends to be kind of simple. And if it isn't simple, we're kind of scared of it, because we are very wary of our own limitations. One of the biggest problems in the whole financial services industry is hubris and overconfidence, and there's no quicker way. There's no quicker way to court disaster. So we're very cautious about that. We want to make sure we understand things. We don't. Value investors always say, "Well, I don't invest in technology," and by and large, we don't. It's not because we have a religious aversion to technology. It's because I could be a genius about some aspect of technology and still not see what was coming down the pipe behind me. Microsoft and Yahoo, with all their billions and huge size and legions of smart people who knew all kinds of scientific facts about the internet and all kinds of stuff about how it worked economically. How does Google creep up on those guys? I'm not going to have sniffed that out. You know, that's not something that I know how to think about. I think that I'll be able to see a threat to beer coming, though, you know, with a lot higher probability than I'll see Google sneaking up on Microsoft or whoever it is that's sneaking up on Google right now. So did I, there are a few hands. Did I get everything?
So what is,
Yeah.
So what is your timeline then? I mean, it seems that I mean, honestly, as a value investor, you're not trying to catch a momentum and play or something, but, you know, you identify a company, then you, like you said, delve into it and we look at everything, identify these set of qualities. I mean, from the time you identify to the time you decide on it, I mean, are you looking at years or?
Yeah, it depends. My favorite answer. Most of what we own, we've followed for years. You know, when I go down the big names, you know, my brother and partner, Chris, was in the business as an analyst for another value shop before he joined me. And so he's got a history of some of these things that goes back before Capco even existed. When I go down the list of our names, there's not much in there that we were not pretty interested in more than 5 years ago. I mean, I'd really have to think to a lot of these things we've been interested in for 8 or 10 years. So, you know, when you follow a lot of things we've either owned a long time, or we've owned them before, sold them based on valuation, and then we got a chance to buy them again. It's not, I mean, we aren't experts on 10,000 companies. And when I say you could line them all up and I could take a hatchet and just shear off huge quantities of them, I mean, I can. I mean, I'm not going to, we don't own any banks. Chris has spent some time trying to find one that he likes. I haven't really. I'm kind of pessimistic that that's a good use of my time. There's probably one that I could embrace, but I don't know if I'd ever be able to find it sorting through all the hundreds of banks. We're very wary of commodities plays. So, you know, we want to understand the influence commodities have on our companies, but I'm not very interested in something that's just a pure speculation on commodities. Technology is something we're very wary of. Could we do something in technology one day? If somehow we achieve the level of certainty about a business, we could. But, you know, it's not a large, the universe of companies that we see is not the universe of companies that's out there. And so that simplifies it. Is that a fair answer? Okay. So what I was going to talk about a little bit is value investing proper in the way we think about it. Business, people, and price. Business, I've sort of backed into a lot of the things that I was going to say, but I did want to go through some of these characteristics. First thing is we want a business that's understandable. The points that I made about a simple, single line, pure play kind of business, there's a lot of virtues to the research. You know, first of all, a business that's in two different businesses, they're not both likely to be jewels. Jewels are pretty rare. So it's more likely you're going to be buying a jewel and something that's kind of okay, and so it's a little less exciting as an investment prospect. But more importantly, your ability to understand one business is greater when that's all the business does. My brother has a line that he likes to use where he says, it would be a better investment world if nobody was allowed to make an investment until they could write down on a piece of paper what the company did, how many units it sold, and what the price of the units was. And the example that he uses is Cisco. And all of us knew, and some of us probably own Cisco. I don't want to pick on anybody. Probably shouldn't call out names. But any number of people invested in Cisco during the boom with a lot of confidence in its technology and its leadership and its management and so on. And Cisco had many virtues, many virtues. It had a lot to say for itself. But how many people, as they thought of, and a lot of, I knew, you knew, all of us knew, lots of people who said, I'm in it for the long run. I know I'm paying a big valuation, but the long-term trend of this is fantastic and the long-term will bail me out. And if the long-term is fantastic, the long-term will bail you out of most prices we're ever likely to see for most businesses. But how many people could confidently make the case for the long run by saying, here's what they sell, here's how many of them they sell, and here's what they cost. Here's what could replace it. I mean, there's follow-on questions, but I've never seen anything that led me to believe that anybody, however expert, could say how many units Cisco sold. Somebody may prove me wrong, but I sure didn't know. I sure didn't see. And we've used this example so many times, and nobody's ever said, you idiot, they sold 3 million routers last year and 6 million servers or whatever it is they sell. That simple rule, I think, says a lot about what it means to understand a business. I mean, you take it through the units to the revenues. You go down through the supply chain to the end consumer, up the supply chain to the supplier, figuring out the costs along the way, what goes into it. You go through the expenses and which ones change with your volume and which ones don't, and what comes out at the bottom. And when you've done that, you know an awful lot about the business. The problem with most businesses is a lot of that is fundamentally unpredictable, but that's what we're trying to avoid. We're looking for things with moats and competitive advantages, which we can talk about some more in a bit. We're looking for things with proven models, and we're looking for things with logical models. We looked hard at, everybody knows what Dolby is, right? It's the sound technology and the algorithms for taking real sound and encoding it so that it'll fit on a CD or a DVD and then replaying it. Dolby has a small competitor called DTS that probably nobody but a serious audiophile would ever have heard of. And DTS has a pretty wonderful business with its own sound technology and essentially a royalty, licensing fees that it gets on DVD players and so on that use it. And there is a lot about that business that is mouth-watering. And we were attracted to it, and we looked at it pretty hard. And one of the great prospects that it had coming down the road was Blu-ray and HD DVD. It was going to be mandatory on both of them, which it had not been in the last DVD cycle. So it was absolutely going to get a royalty on every single unit sold for however long those lasted. And probably going to be big dollars, though Blu-ray hasn't turned out as well as people had hoped. The problem was that at the end of that, and we did try to read about the technology and so on, at the end of that, we couldn't see where there was any place for that to be needed. That it looked like technology was not going to need, it was going to advance to the point that it didn't need any of the, I can't think of the word, it's the process of shrinking it down to encode it so that it will fit on a disk. That data was going to be so much capacity for data that they were going to have lossless sound. And once you're at lossless, you don't need a box that says DTS on it so that people will trust that the sound quality is good. Now maybe sheer momentum would keep the name brand going, but it wasn't something that we could believe in 10 years down the road when the next technology comes around after Blu-ray. Even though you could look at it and say, to a high degree of certainty, they got a good business for a while. We are looking for things with high return on invested capital. I very much distinguish that from high ROE. A good business with a real moat can earn a good return on all of its capital. If you're earning an attractive return on your equity only because you're using leverage, that's not very interesting to me. That just means you have an average business and you're willing to borrow a lot of money. And we generally don't like companies that borrow money. We're looking for businesses with favorable economics, which come in a gazillion varieties. But we like things that earn their profits in cash. When you look down at the cash flow statement, the income keeps right on coming down, and it's not tied up in receivables or tied up in capital expenditures or what have you. We like things that have favorable operating leverage. We like things that have unusual sources of cash, companies that generate capital or generate cash from their working capital, businesses that generate float, subscription businesses, insurance businesses, that kinds of thing. They come in a million different varieties. It's just something that our antennae are always up for. Is there something unusual about this where the business, for some reason, every year generates more cash than its earnings? Highly desirable. We're interested in clean accounting. We are interested in low capital intensity. Always, because it makes for better business, particularly now because there's a lot of reason to think inflation could be coming down the pike. Generally speaking, we're of the view, there's a general view, I think, that the hedge against inflation is to own commodities. To some degree, That is a hedge. We believe that a much better hedge is to own capital advantage businesses, businesses that don't need to reinvest in themselves, that generate their earnings in cash, that have high returns on capital. Those are businesses that are going to see the benefits of inflation without having to pour their profits back into more receivables, more inventory, more what have you. We're interested in modest, reasonable growth. More exciting growth is great. Happy to have it. But it is not necessary to have spectacular growth rates to be successful in investing. If you have a business that is going to be around more or less permanently, a reasonable growth rate combined with other favorable economics of the business is more than enough to make for a very attractive investment. And we're looking for a good balance sheet. If the company needs a lot of leverage to be a good business, it's not a good business. We have a general bias. We want to own businesses that can survive every bad thing that we can think of happening to them. Maybe not the end of Western civilization or a nuclear war, but all of the reasonable, really bad things that we can think about. A lot of, in the crash last year, there were all kinds of comments made that this is unprecedented, nobody could have seen this coming, and so on. Well, it's not totally unprecedented. Markets have always been volatile, and access to capital has always been something that cycles in and cycles out. And even in the best of times, we don't want to own a business that is dependent for its life on access to capital in the short run from the markets in general. That's just not a good position to be in. You don't know what can happen. We want a balance sheet that makes you the master of your own destiny. And sometimes that means no debt, sometimes it means a little debt, sometimes it means holding a lot of cash. Brands, let's come back to that, kind of a big topic, and I'm already kind of going on a long time. Okay, I said three things: quality of business, quality of people, and price. Business we've talked about a little bit. Quality of people is something that I think is way, way underemphasized. I'm sure every investment manager says we want to own quality management. We want honest managers. We want able managers. Everybody says it. We require something more than just the absence of conspicuous flaws. I mean, I talked about burdens of proof before and beyond a reasonable doubt. We're looking for management teams that are able, honest, beyond a reasonable doubt. We do not expect to be let down by our partners in the management of our companies. A good record alone is not proof of ability. There's a lot of double counting, I think, I'm speaking loosely, but there's a lot of double counting that goes on in the investment world where people will look at a business with a good record and they'll say, that's a great business. And they'll look at the manager and they'll say, look at that record. He's a great manager. Very frequently, managers with great records are fortunate to be managing businesses that are well placed in the industry at that particular time. If you were selling oil or natural gas 12 months ago, you had a good record. And that's kind of an easy one to pick on because it didn't last very long. But there's plenty of businesses positioned in a sweet spot that go along for a long time. And it is not necessarily proof of ability that this guy was sitting on the top of the, that this guy was sitting in the boat, while the tide came in and the pond rose. So we're looking for affirmative things that we kind of refer to as flags. We like inside ownership. Compensation is a really big deal to us. It is more popular now to beat up on options than it was. We have always disliked options. There's about 16 different negative things I could say about options. They don't breed the kind of incentives for the most part that they're supposed to. We like management to own stock. We like employees to own stock. One of the great observations, this is one of my brother's observations, you can read a lot about compensation, at least executive compensation, in the proxies, and it's gotten a little better in recent years. One of the things, that was my brother's observation, was, I mean, we all know that management, to some degree, writes its own pay packages, right? I mean, most boards are sort of lapdogs. They aren't really providing oversight and controlling that. They don't have a dog in the fight as much as the managers do. Well, if you assume that managers are writing their own compensation packages, then to the degree that they set performance targets, you can pretty well guess that they're performance targets they believe they can hit. And so when you see, I won't call this guy out by name, but one of our favorite stories from years ago is a guy who's going to get a $50 million business, a $50 million bonus for, basically acquiring his way to a certain size. Well, that's a pretty low hurdle. I mean, if you're going to get $50 million and all you got to go do is spend the shareholders' money on other companies, you're going to be able to do it. And you're going to go do it. What we like to see is compensation systems that are tied to the things that make shareholders money. We like to see bonus banks, where you earned a bonus, it goes into the bank. If things still look good in 5 years, you get it. We like to see formulas that are tied to EVA. That tells me that management gets it. I may not agree with the exact formula of EVA they use. It might not be my exact pick, but they get the basic idea that they're there to produce profitability over and above a cost of capital. That's important. Same for return on capital. I mean, every business is different. Excuse me, what you're looking for is something intelligent that says management cares about delivering good results and getting rewarded when results are good. We read everything. I mean, we read transcripts of calls, we read SEC filings, we read trade publications, you name it. A big thing is footnotes and exhibits in SEC filings. There is so much you can infer about management from the accounting choices that they make. I can give you an example of two home builders that we laid side by side, and one of them expensed everything as they went along. The other one capitalized everything as they went along. Capitalizing obviously makes your current profitability look better, and they can make all kinds of arguments about why that was a more sensible accounting program. But to me, that choice spoke volumes about what they wanted their shareholders to know or think. We are big fans of experience. Yesterday, when I was thinking about this, I took a look at our portfolio. And the 18 companies that we own, 13 of them are still run or have significant senior involvement from one of their founders. Of the other 5, 4 are run by very long-term insiders. The last one is somewhat of a turnaround and in its own category. A friend of mine who runs a venture capital fund made a comment that he'd gone through all of the companies they invested in, and we think of venture capital as sort of two 20-year-olds with a great idea, and somebody gives them some money, and they either fail spectacularly or they turn into Google or something. A lot of venture capital is more basic business than that. The average age of people they had invested in was 52. It was guys who had already had 20 or 30 years in their industry, learning the ropes, figuring out how it worked. The reason this entrepreneur wanted to start a new business was because he knew where the niche was in the existing industry because he'd been around it all of his life. He knew who to call to come work with him, who also would know the business. Age, experience, tenure within the company, bench strength, promoting from within, these are incredibly important things. And frankly, when you see it, it gives you a lot of confidence that the people there know what they're doing. We like managers that are very focused on blocking and tackling as opposed to big picture, grand strategy, blue sky, this will transform everything and it'll all be better. Not just any blocking and tackling, but blocking and tackling that's specifically focused on what makes the business special. Buffett calls these competitive advantages, he calls it the moat around your economic castle. And he says, what we want is we want to see management every day making the moat a little wider and a little deeper. And we completely agree with that. Choices. The choices that managers make say everything about them. Jim Sinegal, the CEO of Costco, has taken heat from Wall Street for years for the very generous pay and benefits that Costco employees receive. Costco has, probably without a doubt, the highest pay scale in retail. It's exceedingly generous, and it kind of sticks out as perhaps an anomaly in a business that is otherwise incredibly, ruthlessly cost sensitive. But that's his philosophy. It's an important part of the model. He's taken a beating for not getting the margins higher, in part because of pay and benefits for employees. And he takes the beating, and he keeps taking it. I'm all for that. That's a quality that I very much appreciate. I would be concerned about somebody who said, this is really important, but if it'll get you guys off my back, okay. That's kind of a big, obvious one. There's lots of others, though. People that, there's a lot of managers who miss something. A rival or a substitute, some new business gains ground in a way that threatens them, and they race to catch up. And sometimes perhaps they have to. But there is a decided phenomenon in acquisitions of chasing growth, of chasing what's working, and paying top dollar for it. It's not something we like to see. The simple decision by some managers to hold cash. If you compared our portfolio to whatever the industry average would be for companies holding cash, we'd be out here in the tails of the curve. We have a lot of companies that hold a lot of cash. They do so at a penalty to their reported return on equity, but that is an incredible safety valve. Disclosure, promotionalism. I mean, you can tell a promotional CEO in about 5 seconds, and that's about how long it takes us to lose interest in that business. Culture, huge. Up and down the ladder, I mean, we like to kick the tires at all different levels of the business, depending on what it is, and see to what degree the principles and philosophy of the guys at the top are actually running through the culture, and what are they doing to perpetuate that. Board composition is a big one. Seeing intelligent people we admire on the board is a plus. Significant shareholders, insider ownership, capital allocation. I mean, this one is almost a bad proverb, and that is the example of a business that decides we're so successful, now we need to go spend $100 million on having a big corporate campus. And it's going to be fabulous, it's going to be a great work environment, and we're all going to be able to do our work so much better because we'll have this great corporate campus. Maybe. That's pretty questionable capital expenditure from our point of view. By comparison, one of our companies made a small acquisition in England a couple years ago, and they inherited with that acquisition some really nice space in England. And as soon as they could, they sold it. And they made a nice profit on selling it, and they moved their people into lesser space. I'm all for it. Integrity is a big and obvious one. Like I say, I think the difference for us is we're looking for something that gets over an affirmative hurdle, not just something where we say, well, I can't see anything obvious that they've done wrong.
You don't really interview managers very often, right? So you are listening to conference calls.
No, we visited, I think, every company. I'd want to look at a list before I said that for sure. We visited, I think, every company that we own at least once. At least one of us has. And that's, I mean, visiting a company means, we're meeting at least at the level of the CFO. Now, that's not 100% true. In the case of Anheuser-Busch, which we don't own anymore, we're not going to get access there. I mean, you can go to the analyst day and you can call the IR department, and if you ask enough hard questions, which is something we try to do, sometimes you can push through IR to get to the CFO. But it varies case by case. We work assiduously at building relationships with the company so that, so we know what we're hearing when they say things to us, B, so that we have the opportunity to ask questions, C, so that we can get access to other things. I mean, I'll give you an example. We looked at, we were looking at the radio industry and Arbitron, more the radio industry, which has just been slaughtered. And we wanted to talk to advertisers and think about the long-term position of radio. And so one of the things we did is we went back to CarMax, and I asked our contact there, could I talk to your chief marketing officer? And he gave me about an hour and a half talking about radio compared to newspaper, compared to TV, and how it fit in, and so on. And that was one of about 10 different data points we got on it. But it's nice to be able to do. And you get that, like anything in life, you get it by having a relationship. Are there times we don't get our questions answered? Absolutely. Absolutely. I mean, we ask a lot of questions. There's generally a sort of prescribed diet of how much information is going to be given to shareholders. And just because we ask a question that goes beyond that doesn't mean we're going to get it. And generally, I think companies are right. Everybody ought to get access to the same information. I'd like it if they gave me an answer and then gave it to everybody else. But it is one of the surprising things about being small, and I guess this was more your question, there's more access than you would think. And in all the years I've been doing this, I think I've been asked twice by companies how big I was. And one of the times I was able to say, well, we're in your top 30 shareholders. Is that big enough? And that was the end of that. So, I mean, it's a legitimate question. I'd be a little incredulous myself if I didn't live it.
I think they have a little more comfort to it, don't they? You're going to be out there. Run your mouth up right now.
Well, yeah, I mean, we're not publishing. I think to some degree they're a little more cautious with sell-side guys because anything they say is going to end up in print. Which is the sell-side guy's job. And, that's not the case for us. But, they're mostly guarded. I think Reg FD was a good thing. I think it made for a level playing field. I think anybody that owns one share ought to be able to call and get their questions answered. And basically, I think that's the way it works. And if it doesn't work that way, if you won't answer our questions, I mean, there's other companies to invest in. Price is the third leg. I'm not going to talk about that a lot. It's very much an art, not a science. We do, for anything we're very serious about at all, we build a full financial model with 10 years or so of history, all 3 financial statements, all the normal ratios and everything that you work through. And we build it by hand because you learn more when you do that. The numbers all come from our reading the actual reports and knowing when accounting changes have been made and so on. And I think that's very important because it's kind of tedious manual labor, but it's very learning rich when you do it. So we build that. We model we model the future in various scenarios. That's less about making a prediction because we don't particularly believe in predictions. It's very hard to know what's going to happen in the future. I know that whatever I put in the model, the one thing that is 100% certain is that's not what's going to happen. We model to learn. We want to understand what happens if sales fall off a cliff, what happens, how much capital is needed in certain scenarios, if they do this, if they do that, what happens if sales really take off and it's a good scenario. Then we look for a reasonable scenario, and we're underwriting to try to get a 15% return in a reasonable scenario. As I say, there's a lot more art than science in that, because just as I know whatever I put in the model is not going to turn out to be the fact, I know that whatever return I've underwritten to is not going to be the return that we see. It's going to be something different, and that's okay. Trying to achieve 15% returns, that is obviously not what the market offers every day. That's part of why we have tended to hold a lot of cash. It means that when you are buying something, you tend to be buying it when there are some negative issues associated with it. And what we're trying to do is find situations where the negative issues are not significant, are being given exaggerated importance by the market, and there are more significant things, where the case is intact. What we would like to do is sort of be the flip side of this. We don't want to be buying things when they're hot and selling them when they're cold. We hope to achieve a little extra added value by doing the opposite. Final comment on price is about preservation of capital, which is, Buffett's quote on this pretty much says it all. It says, rule number 1 is don't lose capital. And rule number 2 is don't forget rule number 1. And he uses the analogy of a dance card, where he says if everybody had a dance card, they got to make 20 investments in their life, and that's it. Your 20th investment, you're done. Think how careful we would be about picking things that were winners. It's a great mental model for that. The last thing, I want to make a couple comments about clients. It's obviously a pretty important part of the business. We think it is incredibly important to have clients with whom you have a good mutual fit. That sounds like kind of a corny cliche, but it's not. Obviously we appreciate them because they are our lifeblood, but they affect our performance and our day-to-day work in other ways. One is that last quarter, there was, the catastrophe in the stock market was significantly a function of forced selling and panicked selling. And ultimately, some of that was other things, but some of it certainly goes to panicked clients redeeming from hedge funds, redeeming from mutual funds, wanting their money back. To be a successful investor, ultimately, it's all about buying when other people are selling. And as a professional money manager, if your clients are selling, you're selling. You can have all the knowledge, all the confidence in the world, and there's a lot of people out there in that boat right now that see great, cheap companies and want to buy on them, and they can't because their clients are pulling their money. That's huge. Another thing that's important is with the right client base, they can give you insights about particular businesses. They can give you introductions to people that are in those businesses. You can learn a ton about a business by going and talking to a small business owner in that field, because I guarantee you, if they're successful, they know everything about it. And they will often give you a lot more information than an IR department will. Another aspect of it is the simple one. There's only 2 of us. If a job needs to be done in the office, one of us has to take time from research to do it. If our clients needed a lot of hand-holding, it would be a problem. Fortunately, they don't. I said a mutual fit, and just as we expect something from them, I think they have a right to expect a lot from us. And obviously, at the end of the day, what they're looking for from us is preservation of capital and reasonable performance, depending on what the environment gives us. And that's what we work hard at giving them. But there's a lot of other things that we can give them that are a little more in our direct control. And one is, and I suggest this as a way of, I think it would be hard to find an investment manager for me if I was a layperson, because you can take 100 of them or 1,000 of them and go read all their stuff, and I don't want this to sound totally disparaging. You can read all their stuff and not know anything about what they do, what their philosophy is, who they are, how they go about the investment problem. A lot of it's written in a very vanilla way to not scare anybody off, to be appealing to all potential comers, and that kind of thing. That's not really what I would want. I would want to read 20 different options, and they all say with conviction what they do, and they're all different things, and I can go through it and I can say, golly, that one really makes sense to me. That's the guy I want. That's hard. And so because it's not out there, I think there's a tendency not to look for it, to accept the fact that it's not there. I would encourage people to look for things like this. As managers, we can give our clients a clearly articulated philosophy. We can tell them what it is we do, what we're looking for. We can stick to that philosophy. That almost goes without saying. We can be transparent about what we own and why. In our business, we try to minimize hand-holding, and we are blessed with a client base that makes that possible. At the same time, we're not expecting them to blindly trust us. We're a black box and they put the money in and they hope it all works out in the end. We've told them what we're going to do, and every quarter we send them a letter. We give them our general thoughts on various subjects, and then we have a portion that we limit to clients that talks about our portfolio. And we say, here's what we bought. If we bought something new, we're going to give them a couple pages describing in detail why we own it, why it fits the criteria that we're looking for. If something significant happened to our company, good or bad, we're going to say so. If we made a mistake, we're going to say we made a mistake. It seems pretty basic to me, but you will search long and hard for communications from most managers that sort of meet that template. Another thing is a good fiduciary structure, and I think a lot of clients don't appreciate it, and that's okay. I mean, it's not a huge selling point. I hope that they appreciate that we're honest and hardworking and so on. They don't necessarily appreciate the particular decisions that we make. I'll give you an example, one that's very obscure. We talked about this at lunch a little bit. We spent a bunch of extra money on software for our fund so that we could do something called tax lot layering. And all that is it is a tax election that means at the end of the year, when they get their tax results, they are going to match up with the economic results that they saw over the period of their ownership. If we sell Costco this year, then somebody that's been with us for 7 years is going to see tax results that exactly match the different cash flows that he put into the business and that he put into the fund and his time period of ownership. That isn't the way mutual funds work. It isn't the way the vast majority of hedge funds work. I'll spare you the gory details. It doesn't make us saints, but it's a little better. It's the way it ought to be done. And it doesn't get us much benefit, but we had a choice to make, and we like that we made that choice. I think a lot of the fiduciary stuff is like that. Your clients probably never know, but in some way you hope that they get a vibe that that's the kind of person that you are. I said performance was not the right way to judge a manager. So I want to give you the performance stat that I am absolutely the most proud of, and that is that last quarter when the roof was caving in and everything looked horrible, and we were down too. We weren't down as much as the market, but it wasn't pretty. Our clients, we didn't get a single call that was panicky. We didn't get a single call saying, I want to pull my money out. We had new clients come in. We had clients add money. So I'm very serious when I say the fit with clients is incredibly important, and it makes all the difference. We were buyers steadily through that whole period. So I think I said at the top that the basic theme that I want to talk about was or the overarching principle is kind of consistency of philosophy and personality and process. All of those things fitting together, I think, are very powerful. If you take the index fund example, the philosophy is to minimize cost. It's to get the average result, minimize the cost. And so in that case, philosophy and process and personality are completely intertwined because there is no personality. There is no process. All those are costs. They're taken out. I mean, that's what makes indexing the beautiful thing that it is. How are those things consistent for us? I kind of scribble. I mean, you could almost do a circle. I mean, we're active managers, and I talked about that. That leads you logically, inevitably, I think, to being concentrated. Well, if you're going to concentrate your investments, you better be research intensive. That's going to lead you to long holding periods, because if you're concentrating your work, you better concentrate your positions and how long you hold them. Long holding periods means you better own quality businesses. Quality businesses means you're going to reject things like arbitrary size criteria. You're going to be willing to hold cash, because if you're only going to buy it when it's quality, then sometimes you're not going to buy something. It leads you to looking for mispricing. And it leads you to, I think, a certain kind of relationship with your client. One that hopefully is consistent with the relationship that we expect from our companies and with the qualities in companies that we're looking for. So that's kind of everything that I had prepared. Happy to take any questions or...
If it's just you and your brother, how do you go about marketing to acquire clients?
It's pretty much all word of mouth. It starts with relationships that we already had, friends, some of my clients as a lawyer, some of whom I spent more time talking about investing than I did their cases, which should have been a sign of something. And it kind of goes from there. I mean, we rely heavily on introductions and referrals. Those have been good sources for us. The quarterly letter, we're always looking to add new, we do two versions of it. We have the general version where we talk about our thoughts, and then we have the client-only portion. But the general version, we send out pretty widely. We'll put pretty much anybody on that email list. If they want to receive it, we're happy to have our name pop up in front of them every 4 quarters. And every so often, we send that out, and somebody calls and says, hey, what's your minimum? We say, great. It doesn't cost us anything. We could definitely be better marketed. It is something that we work sort of intermittently on improving. We slow, steady growth with the right kind of clients will give us all the success that we need. So I'm not really willing to compromise the quality of clients in order to get more of them, but I think there's plenty of people that would appreciate it, and I'd love to get the word out more. And the question was, I should have repeated it, the question was, how do you market yourself to others? Yes?
When you set up your valuation model, what type of discounts do you use to discount the cash flows to arrive at an enterprise value for the company? And do you add a risk-adjusted measure or add some type of increase to determine the margin of safety, or do you just allow your screening process to kind of pre-select companies and that's how you get through it? And then 2, what type of discount do you need to market value to be able to pull the trigger on an investment you've watched for 5 years?
Okay, let me see if I can repeat all those questions, and then if I don't answer them all, you can keep me honest. What discount rate do we use when we model companies to arrive at a present value? The third question was, what discount do you then demand from that value before you're willing to pull the trigger? And what was the middle question?
Yeah, that was essentially the 2 questions.
Okay.
How do you arrive at your discount rate? Is there a margin of safety built into that, or do you just allow your process to screen it?
Yeah. Margin of safety, usually when people refer to margin of safety, they're almost always talking about price. When we talk about margin of safety, we emphasize that it's a lot of things. You get a margin of safety from the quality of the business you own. You get a margin of safety from the quality of the management that you have chosen to partner with. So it's not just price. As far as the technical question, when we model a company, and this makes us, the vast majority of the industry, I know, they do the discounted cash flow, they discount it back, and that produces a present value. Well, the discount rate is totally arbitrary. And so, as this is one of the changes that was kind of inspired by my brother. His point, his sort of intellectual point on all this is, why use a discount rate at all? You are plugging in an arbitrary number so that you can arrive at a price that has false precision, and then you will forever have to think about what the discount rate was that allowed you to arrive at that. So that's not the approach. Now, since we don't produce a here's what the company is worth number, we also don't do a discount from that to decide what price we can pay. What we do the exact same discounted cash flow. No difference at all. But what we do is more like what a company would do with its own internal capital expenditure projects. We do an IRR. We discount, we do those cash flows. We say, what rate does that discount back to the present price at? And we're looking for 15%. We're looking for a reasonable scenario, and depending on the risk and safety characteristics, we might deviate from that a little bit. We're very cognizant that the number we have produced, because you get a very precise number, right? You discount it back at 15%, and it tells you that you can pay $42.71 a share. Well, that's ridiculous. I mean, $42.71 is no better a number than 41 or 43 or whatever. We know that's the range. And then depending on sort of subjectively how we feel about that, we might be a little more eager We might be a little less eager. There's times that we've looked at something and we've said, I like it a lot, it's probably great, but why don't we discount it at 20 anyway? It doesn't happen very often. 15 is a pretty rich discount rate, and if we achieve 15% returns, that'll be terrific. And people, I mean, just a related comment, we have been asked on any number of occasions, well, what kind of performance should I expect from you? Or they say, so I guess that means I should expect 15% a year. Well, it's not what you should expect. 15% is what we underwrite to. The real world is going to turn out to be something different than that scenario. Another wild card in that is if we're holding a lot of cash and we have successfully put the rest of our cash into 15% returners, well, we're not going to return 15%. That was the math question you were asking. There is no question that cash in your portfolio is a drag on your performance. And you make a choice to risk underperforming or to risk running around with no cash. And right now we think things are cheap, so we're running around with very little cash. Yes?
Can you talk a little bit about the Madoff case?
The what case?
Madoff.
Oh, yes. The question is, can I talk a little bit about the Madoff case? I actually jotted down some notes on that at the last minute because I thought, well, that's something people might logically ask about. Tell me specifically what you're asking me. Are you asking how does somebody avoid a Madoff? How do I know you're not Madoff?
No, from your point of view, how did he manage to stay in Goodies for so long?
I would say that is primarily because the financial services world is full of people who don't always ask questions until they've gotten to primary sources or until they know what they need to know. And Madoff must have had a gift for finding people that weren't going to ask hard questions. It's obviously a horrendous tragedy. It is a mystery to me that he could have succeeded on such a massive scale. I mean, that Ponzi schemes happen all the time. It's not a mystery that he could succeed, but that it could be that big is kind of strange. And it's a mystery to me that, Harry Markopoulos's 2005 submission to the SEC where he said, I think it's titled something like, the biggest hedge fund fraud in the world. It's out there on the internet, and I've downloaded it and read most of it. And it is inconceivable to me that would not get somebody's attention and have them all over this guy to figure out what was going on. There are some very, very simple, obvious red flags. When the size of your assets under management mandates that your strategy represents more than 100% of the documented volume, that even the SEC ought to be able to figure out that there's probably a red flag there. So what I thought you were going to ask, and what I jotted down some notes on, was, good Lord, how do I avoid investing with Bernard Madoff? How do I recognize, you're safe from Madoff now, but how do you recognize the next guy? And some of the problem with Madoff was very unique to him. The fact that he was his own custodian is basically what made this possible. That's almost a unique circumstance.
For people that
clarify what that means.
Unbelievable, right? Because people were having the popular press have been very up on the fact that he used as sort of a flaky guy and that's an auditor, and I don't think people appreciate that has very little to do with any of this, and that it's the custodian.
Yeah. So here's the issue with the custodian, and I'll tell you how we work. We have a pooled investment fund, and then we have separate accounts that we manage, basically on the same strategy, mostly IRAs. We only use one custodian, that's Fidelity. Fidelity is, doesn't engage in a lot of the other stuff that's brought down broker-dealers, and we always liked that. Wouldn't necessarily have jeopardized our clients' assets, but we still always liked it. Fidelity, at the end of every month, they send every one of our individual account clients a statement direct from Fidelity, untouched by us, that says, here's your account. There's $187,000 worth of stuff in it. You own 60 shares of this, 30 shares of that, whatever. You've all gotten statements. For the fund, we send information to our limited partners. But the fund is audited. And our auditor goes directly to Fidelity and they say, send me the statements, send me a verification of the cash that they're telling me that they hold, and so on. And so the audit serves that function of going to the original custodian, who I assure you is way outside of my ability to control or influence, and verifying that what we say is there is in fact there. That's
All the trades that you make.
Oh yeah, exactly.
Through Fidelity, they don't go.
Correct. Everything runs through Fidelity. So that is the sole source of information, and we never touch any of the money in any of these accounts. Clients write checks to the entity, and the checks get mailed directly up to Fidelity. We don't and never want to have custody for 1 second of $1. The difference for Madoff is Madoff was his own custodian. He was us, and he was Fidelity. And so he produced monthly statements that said, here's the trading in your account, and all they are is pieces of paper that he printed out. They don't have any connection to reality. They don't have to. He's in total control. I think, I can't remember ever reading about a scandal where the custodian was doing something like this, and perhaps people weren't attuned to it as a risk. I don't know that I would have thought, my God, that's insane, but his whole thing was so weird. That maybe it should have, people that were giving him millions or billions of dollars, it should have given them pause. They should have gone down, they should have analyzed the entire value chain the same way we would look at a company and say, how does the whole thing work? And does that make sense? And why on earth is he doing it this way when nobody on the rest of the planet is? But that's kind of unique to him, and I don't think you guys are very likely to run into somebody who is both their own investment manager and their own custodian. And if you do, I would recommend that there's probably some other choices out there. Some of the stuff that I think is more recognizable, and it's kind of like the flags that we talk about in character. When a guy who has an investment strategy has bizarrely consistent returns, there's something not right about that. For years and years, I hesitate to criticize by name, but I'll do it anyway. AIG and GE were, they sort of built their stock market brand on consistent growth. We're going to grow whatever the number was, 12% a year, every year, year in, year out, no matter the economic environment. Well, everybody knows that's not possible. They're both big cyclical businesses. That's not the way the world works. And everybody winked and nodded and connived at accepting the fact that they played accounting games to achieve it. Honestly, I don't really understand that. It's like the emperor's new clothes phenomenon. I don't understand how everybody stands around and says these companies are 12% growers when they intellectually know that they aren't. And sooner or later, you take restatements, and turns out you weren't a 12% grower. Big surprise. So when Madoff has this straight line up, that ought to raise red flags. A key piece of his marketing was emphasizing risklessness. All we do is talk about risks. Our letters are nonstop. This is what could go wrong, but here's why we think we're okay. We are not promising a riskless deal, and anybody who is they better be owning treasuries, and they better be short term. I think his lifestyle would be a little bit of a cue. Now, maybe not. He's a successful guy for a really long time, but he lived pretty large. The captive auditor ought to raise some questions. When a guy who's managing billions of dollars has his audit done by a 3-person shop, one of whom's a secretary, and one of whom's 80 years old and lives in Florida, it's not, when you manage billions of dollars, it's not that expensive to go hire the Big Four. The opaque strategy. I mean, I've said that I think something that any manager, almost any manager, can give his client is a clearly articulated strategy. There was, anyway, so much hullabaloo around hedge funds, and every hedge fund manager had to be a black box. And it's kind of part of their marketing. We got this great strategy. Nobody can know what it is. It's super secret. Everybody would copy it. Well, there's thousands of these guys. I mean, the world's not, they're not all being tracked with breathless anticipation, by people dying to copy them. A lot of them weren't doing things that were that complicated, really. The idea that somebody's strategy has to go undisclosed, I'm just very skeptical of it. Now, I say that, and Warren Buffett in the 50s, his initial investment partnership, he wouldn't tell anybody what he owned, and if you pressed hard for details, he kicked you out. Luckily for those guys, Warren Buffett was honest. And maybe they had enough of a read on him that they could be confident of that. I think that's reasonable. We don't feel like it's necessary. I think it's a big piece of the puzzle. We tell people what we own. They see the performance happen after we own it. And if they want to go sit down and do the math, they can see he's not reporting fake performance. I mean, if we were going to report fake performance, we wouldn't have reported the performance we did this year. I can tell you that. So anyway, I think, asking questions, and that's my brother's beginning was not in finance; it was in internal audit, and he'd go in and he'd analyze processes and so on. And he said initially that he produced, he'd do a write-up on something, and his write-ups would say, well, it seems that, apparently, it appears to be the case that, and the guy that he worked for, who must have had a good, rigorous way of thinking that I like, said every time you write apparently, or I think, or it seems, I want you to strike that out and write, I don't know if, and that's, you either know or you don't know. And with Madoff, everybody that invested with him, when you get down to it, they didn't know. And if you choose to run that risk anyway, then I guess you do. But I sympathize with those people. It sucks, and there's a lot of hard stories that came out of that.
Can you talk a little bit about your self-discipline? Like, when would you look at leaving a position like Costco, and because your IRR shrunk, or just the new opportunities in the future for that company have gotten a lot smaller?
Yeah. So the question is, what is our sell discipline? And there's kind of a classic formula that is tried and true among value investors. And let's see if I can remember all four of the elements. Or maybe it's 3 elements. You sell when something's undervalued. You sell when there's been a fundamental change. And you sell when you recognize that you've made a mistake. For us, it's a little more. It's more like 4 elements for us. Because we distinguish somewhat between really fantastic companies and pretty good companies, but not in the same league. If it's a really fantastic company, we're not going to sell at just when it's fairly valued. We're not going to sell unless it's kind of substantially overvalued. It's pretty hard to find these things. It's pretty hard to get into them. It's hard to find the company. It's hard to find them at a price you're willing to pay. We're skeptical and conservative, and so we tend to underestimate the good things that can happen. And so that's going to cause us to think something is fully valued before it is. Everything that we do leads us to saying we're going to be hesitant to sell unless things have changed or we're wrong. If it's just an okay company, then we want to sell at something more like fair value. Now, back to his question, we don't actually have a whiteboard back at the office where we say this is $32 and that's what it's worth. What happens is, as the price moves up, that IRR that we've calculated, it's coming down. It had an 18% IRR when we bought it, we hope, and a year goes by and we update the model, things have changed, didn't turn out exactly like the way we thought. We got new information, new understanding. Now there's different cash flows and a higher stock price, and now the model discounts at 14%. Yeah, that's fine. I'm happy with that. And then a little time goes by, and one day it discounts at 8%. Well, now it's starting to get to, how do you feel about this company? And what are your other alternatives? You might not sell yet, but then one day the IRR is 4%. I got to really be in love with something and really think I've been too conservative to be, attracted to a 4% return. So, I mean, it's, again, it's art, not science. There's not a hard number that we hit. Kind of depends on the other opportunities, how we feel overall, want to raise cash, that kind of thing. The other two things are kind of obvious. I mean, if we make a mistake, we make a mistake. And there's a book I will recommend to you is called Influence by a guy named Robert Cialdini, Cialdini. Great book, easy read, pretty short. It's basically about the psychology of misjudgment and the way that we make mistakes. It's a lot like the organizational behavior class you took, only it's a better read than the textbook was. There's a concept that one of his topics is consistency, a commitment and consistency. You've made a decision, we've said it's a great company, and we're going to go down with the ship, flags flying. We're very loyal to our companies, and we will stick with them through thick and thin. But when the problem is that we made a mistake, and we were wrong, and these guys aren't high quality, and they don't have a moat around their business, that's not the time to go down with the ship. We made a mistake, we say so, and we move on. And then the other one is something fundamental changes in the prospects for the business. And that's why we stay on top of our companies. One day a competitive threat will emerge to everything we own with certainty. Nothing is safe forever. And so we're vigilant for those threats, and we try to think hard about where they could come from.
Between two brothers, there are definitely going to be disagreements and investments. How do you handle this, and what is an example of a time when you disagree on companies?
Brothers not getting along? I don't know what you're talking about. I don't know what kind of family you were raised in. Anybody with a sibling knows that nobody, there's no fight like a fight between siblings. And we have different personalities and different wiring. When we got together, we recognized the possibility that sometimes we would not agree. And what we did not want to do is have every decision has to be made by committee. And so what we wrote into our charter is any one of us can buy or sell any position anytime. And the other one gets to decide how much. Excuse me. That depends a lot on good faith. I mean, I can say I want to buy Costco, and Chris can say, that's fine, 1 share. I mean, that's not really the intention of it, and we're intellectually honest enough to not execute it in that way. I kind of figured that there'd be 1 or 2 of those every now and then, and the reality is, haven't really been any. There've been a lot of knockdown, drag-out fights, about valuation. Is this too high? There've been a lot of knockdown, drag-out fights about, one of us gets convinced of the strategic position, the competitive advantages, and the other one isn't buying it. Those are good if you're acting in, if you're debating these things in good faith. We raise our voices, and we go home angry sometimes, and there's certainly times we've each thought the other one was a complete blind idiot. But, generally speaking, if one of us really doesn't like something, there's usually a reason. And there's other fish in the sea. And so we actually haven't had an occasion to use that where I just say, well, that's ridiculous, you're an idiot, and we're buying it. So that's, it is interesting. It is, I'll tell you one of the great advantages. There's nobody more trustworthy that I know than my brother, and I hope he feels the same about me. He does the accounting for, our business. I'm not talking about the partnership now. I'm talking about the management company that provides services to our clients and runs the funds. He does all the accounting for it. I've never looked at it. Having a partner that you trust implicitly, whether he's your brother or not, is everything in life. I mean, Warren Buffett had a great a year or so ago. He was talking about trust, and said, I got a million, the guys that had lunch with me will tell you I'm full of corny quotes and cliches, but I believe them. He said, trust is basically the most important fundamental lubricant of the economy. I mean, if we work in an economy where we can't trust anybody, where if I go buy an orange, I got to feel it and squeeze it and smell it, and still not sure even when I take it home until I eat it if I can trust that the guy gave me a decent orange. I mean, we impose all these different costs of monitoring and investigation and a lot of intangible soft things, but it's a very different world than you go put your money in the bank, you know it's going to be there tomorrow, even if the bank fails. And that's, the people that you do business with in your personal life. I mean, it's a rough way to get through your life if you got to be double checking and not trusting people. So put that in the category of career advice, I guess. So that part of it is a huge blessing. Yeah, back there.
Let's say with a credit crisis and a housing bubble, other than government spending, do you see any positive drivers of corporate earnings over the next 2 to 3 years?
I think things are horrible and they're going to get worse. Do I see positive drivers for corporate earnings? We're not really macro driven. I'm not a macro economist. I try to be well informed. I try to think about how these things could impact us if they happen. We try to own things that can survive a whole range of bad scenarios. Do I see drivers for corporate earnings broadly? No, I think it's going to be bad. I think it's going to be real bad. Do I think that, am I nonetheless fully invested? I am. Am I enthusiastic about what I'm invested in? I am. I think every investor at some level faces a choice between, you can own things where everything feels good and there's not anything right now to be scared of. The news is good, prospects are good, things are cheery. Where you can own things, and the valuations reflect that. Where you can own things where the outlook is bleak, and the valuations reflect that. I think history says that if you have to choose between a cheerful outlook and cheap valuations, and you have to make that choice. You're better off choosing cheap valuations and taking your lumps from the bleak outlook. Now, you better be able to survive that bleak outlook. And I'm not completely pessimistic. I told you we write these quarterly letters. We are working on a topic around the idea of making forward progress in a downturn, playing offense in a downturn. And as bad as it is, it's not all bad for everybody. There's a severe housing crunch, but if you're shopping for homes, okay, that's better. If you are a retailer, like we think Costco is, that's going to be expanding for a long period of time to come, it's not bad that they need big parcels of land. And for a long time, they've been competing with people that want to put up a subdivision there. It's not a bad thing that land is now going begging. The same thing is true for Ritchie Brothers Auctioneers, which is another big investment for us. Any of you guys ever drive by their site on I-4 between Orlando and Tampa? Big sites. Landstar, which is our non-asset owning trucking company, has a lot of opportunities to play offense. They are dependent on agents for their business, and they're signing up new agents at a rate that we haven't seen before in better times. Because now, they're the strong hand in bad times. And that's hugely important. Even some of our companies that are going to have a harder time, if you have cash, you can both survive, you can do some acquisitions, and you can come out on the other side in a world where the competitive environment is thinner. What is that? What is the other side going to look like? I don't know. And I think we're in for a rough time in the meantime.
1 minute.
1 minute?
Because I got English 4. This is a short.
I don't have anything else to say.
I got a question for you.
Okay.
You've been 1 minute to answer. Your performance has been good.
Mm-hmm.
over the long haul. But what's the one most disastrous name you ever bought, and what happened?
I'm sorry, we're out of time.
No.
Most disastrous name we ever bought.
If you still own it, then you don't have to talk about it.
No, we don't own it. Most disastrous name we ever bought was a private label soft drink maker called Cott. And if you want to talk about every single thing that can go wrong with a company, there's your case study. They did not have the moat that we thought that they had. They did not have the management that we thought that they had. They had what we thought was modest leverage. But when you go into a ruinous environment for soft drinks and a ruinous commodities environment for their costs, you annihilate your interest coverage, and modest leverage becomes crippling leverage. And we then did, the cardinal sin of not recognizing our mistake. We followed it down. I mean, each time it got hammered, we said, well, it's bad, but now it's cheap relative to what we think it's. Our value for it is lower, but now it's cheap relative to that. And we kind of stair-stepped down with it, where we would have been far better off going to a blank slate, which we talk about all the time and recommend to everybody in sight as just a failing on our part. We should have gone to a blank slate and said, would we buy it today? If we didn't own it already, would we buy it today? And we followed it most of the way down. So, that's luckily that is the only. We got a couple things where we, made mistakes and lost a little money, but very modest on small position sizes. One where we changed our position on. We bought it before we had met with management. We try not to, but you can't always do that. Chris went up and met with management and was asking him the hard questions that we like to ask. And I won't tell you which company this was. But the guy, looked at his feet and shuffled his feet and clapped Chris on the back and said, "That's the past. We're here to talk about the future." That's the wrong answer. He came back, and without any more discussion than that, we said, all right, we're going to sell. And then we had one other where where it was mostly the environment changed dramatically around it at an explosive rate. And, that's one where we said we made a mistake. Not so much we made a mistake. Circumstances changed, and we didn't see it coming, so it was a mistake in that sense, and we pulled the plug on that. That's, I think that's pretty much it for 7 years.
Thank you.
Thank you, guys.